This explains what a stock is, what a CFD is, and how they are related. A stock is a share of ownership in a company. By purchasing a stock, you become a shareholder in that company. You may benefit from dividends, can vote on key corporate decisions, and possess certain rights. To buy 100 stocks in company ABC at $10, you need $1,000. Purchase equals ownership. The price of a stock goes up and down depending on many factors. You purchase the stock at a quoted price, and the rise or decline in the stock's value results in either a profit or a loss. It's considered a traditional way to trade financial markets. So what about a CFD? A CFD, contract for difference, is a contract between you, the investor, and a CFD provider. It's an agreement to settle in cash the difference between an opening price and a closing price of a particular asset that you have taken a position on. The CFD then tracks that asset price. That's the direct relationship between them. You take the position based on whether you think the asset will go up or down in value. So, for example, you can place a CFD trade on a stock and the value of the CFD position will rise or fall with that stock price. The stock is therefore known as the underlying asset. And as you are purchasing a CFD from a provider, you don't own that underlying stock. Not owning the stock leads to some key differences. For example, CFDs are traded on margin. You only have to put up collateral. This means you can leverage your capital. The amount of margin required varies and is defined by your provider. If it's 5%, typical for large companies like Apple, then that is equivalent to 20 times leverage. Buying the ABC stocks in the example at the start of this CFD explainer was $1,000. If you bought them with a CFD at 5% margin, you would require $50 in your account. Your profit or loss would move with the ABC stock price in the same way as if you owned it. Therefore, the low CFD margin requirement means any profit percentage is higher, but any downward movement is also magnified. And trading stocks mean you have to purchase them before you can sell, meaning that you can profit from a rising price only after you've bought the stock. If the stock drops below your purchase price, you lose out. If you believe that the general market trend is downwards, CFDs are going to be beneficial to your strategy. But CFD trading means that you can sell stocks that you don't own. Remember, it's still a contract between you and the CFD provider, not ownership. Therefore, CFDs allow you to benefit from a falling market. You can sell a CFD on a stock that you believe will fall in price and then aim to buy it back later for less money and make a profit. But remember, if it rises in value, you'll potentially lose money. And stock trading is one asset type or class. A CFD, on the other hand, is an instrument or derivative. Therefore, CFDs can be used to deal on stocks, foreign exchange, commodities, etc. And therefore, more international markets open up to you as an investor, allowing for portfolio diversification, all from one CFD account.